Okay, very good morning. It is Wednesday the 21st of February, so I hope everyone is well. Today, a memorable day. Someone like Sam will remember today 2 years ago, specifically, very well. Because it was 2 years ago today that David Cameron stood up in Downing Street, hailed his pre-referendum package that he had negotiated with Europe, and told the public, whatever you decide, I'll do my best to deliver it. And then the rest, they say, is history. So, yep, it was Mr. Cameron obviously then putting forward the date of the June referendum that initiated the Brexit saga. So yeah, 2 years ago to the day. Quite incredible to think that how time flies when you're having fun. Looking at the briefing then this morning, usual routine. I'll talk about the news specifically. I'll hand you over to Sam, and then he can have a look at some of the charts in a bit more detail and the setups that he's looking at. But just in an overview of what's been going on, I guess we got to start really with what happened yesterday, because we had a down day in terms of the US equity market. So S&P was down about 0.6, the Dow down about 1%. The Nasdaq though was an outperformer, and if you remember, we were talking, I was posting in the chat room about the divergence that you were seeing materialize between the underperforming Dow and the outperforming chip stocks. So one thing to make a bit more sense of this obviously is the heat map, which we were looking at, and there's obviously right in the center, Walmart finished down 10.2%. Now, I'm trying to remember the specific number, but a loss of 10% equates to about $25 billion off your market capitalization in one day. So, yeah, no small fry move here for a company of that size, and consequently why then the impact was so heavy on the Dow. It is one of the larger components of that index in terms of its percentage calculation. But not only does Walmart move lower, obviously the associated discount and variety stores continue to move lower in sympathy as well. So you got Target, Dollar General, Costco, Dollar Tree, all those US names that are at that end of the retail sector all fell in sympathy. The outperformers, of course, were this little sweet spot, helping lift some of the tech names, and particularly semiconductor, specialized in equipment and material makers, chip makers. Micron Tech had earnings, they were also up, and so you had a little bit of a divergence between the different indices. So hopefully just explaining that in a bit more detail. So a negative close on Wall Street. Overnight in Asia, it's been relatively quiet. There's not been a great deal for me to comment on. There was some, I think, Aussie wage data, but nothing really too significant in that sense. We did have the slight negative sentiment, I guess, to the open this morning. As you can see from this chart, the S&P has broken a 6-day consecutive rally on the back of, as described here, earnings disappointment, particularly that around Apple, Home Depot were the same. So you can see the first down day we've had in a while. So there's a little bit of a lingering effect, I guess, of that from the US close last night, given the fact that not a great deal's happened overnight in Asia. Don't forget, the likes of mainland China still celebrating the Lunar New Year holidays. So DAX a little bit heavy this morning. As we've gone through the cash open in the last half an hour. US futures seem marginally lower as well at the moment, and obviously, I mean, Sam will talk about this more, but you can see here we're just testing the kind of double bottom that we've had from overnight in the mid part of the Asia Pac session, and then just before the close last night before we bounced. So just keeping an eye on that 27.06 1/4 in the S&P. Other things to be aware of though. We've had data this morning, and this has been the flash PMI data, so for the month of February, and just having a quick look. So the French service PMI, you can see here, it came in slightly lower than expected, pointing to the slowest expansion in the service sector in France in 4 months. Sticking with France on the manufacturing side, exactly the same. the slowest expansion in factory sector in 4 months as well. Germany, we've just had come out, and it's a pretty similar story, a little bit softer than expected on both measurements. I guess the thing to do with this type of data is if you look at the charts this morning, it's really not having much in a direct read across into impacting market prices, because even though these data points are slightly weaker than expected, let's not forget that they're not a big miss on expectations, it's only slight. And even if you take, for example, a country like Germany, which is obviously geared on the manufacturing sector, if we look at the manufacturing PMI specifically for that country and we start putting in it on a, let's say, a 10-year chart, or let's say a 5-year, you can see here we are still highly elevated in the context of recent historical data. So even though this number's come in a little touch weaker than expected, it by no means is going to change the narrative of what people are thinking about Europe, which I guess the exception is Ray Dalio, but everyone else from a PMI indicator point of view, this is fairly robust at the moment. And even if you go back to France, let's take the French manufacturing situation, it's telling you a pretty similar story. Comparative to where we were, which was in the low 40s, we are still high despite this slight dip and turn off the highs that we've had. Okay, a few other things to talk about. So, got to talk about Brexit, of course, on this memorable day from 2 years ago, as I mentioned. So, this is the latest. And if you remember yesterday, we had that Business Insider report, which did contribute to some short-term sterling strength on the back of an apparent olive branch from Europe breaking the mold of their kind of more aggressive negotiating stance and saying that they're willing to offer flexibility in talks to Britain. So this is the latest from the British side, and there's a couple of interesting points here that I just wanted to run through. So in summary, as the title would suggest, what's happened is there's a group of Tory Eurosceptic MPs who have basically urging via a letter the PM to hold firm on plans for Brexit to mean leaving the single union and customs union. So the demands of this have come from 62 people, majority of which have remained unnamed, included full regulatory autonomy outside the EU and the ability for Britain to start negotiating trade deals throughout the 2-year transitional period that begins obviously when Article 50 elapses in March 2019. The MPs have said if Theresa May can do that, then they'll continue to support her, which does bring about, certainly if you start reading between the lines, I think a good quote came from Nicky Morgan, who's a Tory MP, who said that this isn't really a letter of support, it's more of a ransom note, which I think is pretty much right on the money. The other thing that's going on here is obviously what is the opposition party doing, the Labour Party? Well, the silent Jeremy Corbyn appears and says that the letter has come as Jeremy Corbyn predicted that the UK would have to have a customs union with the EU after Brexit. So in comments that are basically a shift in the Labour Party stance, which does pose a slight danger to Mrs May in Parliament, because at the moment what you're getting then is that, you know, quite a tactical move, I'd say, from Corbyn, who generally his tactic has been to say nothing and let the Conservative Party self-combust and then just be the alternative choice. But he's lining himself up for the kind of softer Brexit in a sense of remaining with the customs union, and if Theresa May is held ransom to the likes of backbenchers like Jacob Rees-Mogg, for example, who are much more of the it's our way or no way situation, then obviously you're creating quite a sharp division between a hard Brexit and a soft Brexit, which could then obviously jeopardise not only Theresa May's fate as the leader of the party, but also push people towards then potentially the opposition, given a transition deal secured on a softer Brexit ultimately would be more market friendly in that sense. The other thing that Labour are talking about is that the need for this customs union access, i.e. with the EU after Brexit, is to avoid a hard border with Ireland. And I've said this for many months. I do feel that that is a real key sticking point of this whole entire Brexit deal. And so the kind of Brexiteers that you've got for these Eurosceptics who've put forward this letter to Theresa May, the fact that they want full regulatory autonomy, and the fact as well that they want to leave the single union and customs union, I just think that this is just not going to happen in reality because of the Northern Irish issue in particular. So it's interesting to see what's happening here. There's obviously a lot of moving parts within the Tory party at the moment. Theresa May is just another example of her not really having too much in the way of authority within her party. So a couple of other points just to round off this issue. Mrs May, don't forget, has ruled out Britain staying in the customs union. So this is the current government's mandate. But some pro-European Conservative MPs this month have joined forces with Labour backbenchers to table legislative amendments to Brexit bills. So what this could mean is if enough pro-European Tories sided with Labour on the issue, i.e. this division about the customs and single market, then effectively this could start to bring down Theresa May, given the fact that she does have still a fairly slim or working majority only in the Houses of Parliament. So yeah, quite a few interesting bits that are ongoing at the moment. The EU, what have they said in response to this? Well, the current stance is that the EU has warned Britain that it cannot expect to have access to the single market on current terms after Brexit if it ends free movement of people and moves outside the bloc's legal and regulatory framework. So in effect, this letter that's been put forth by the 62 Tory MPs who are Eurosceptics is the complete opposite of what Europe is saying at the moment would be acceptable. So yeah, still interesting at the moment. Is it really moving the pound? Well, if you look at cable this morning, it is a little heavy, but again, if you look at euro dollar and cable, they're both down a similar margin, about 20 to 30 pips. So I'd say in reality this is almost a repeat of yesterday morning, where you've got a little bit of dollar strength more than anything. The dollar index is up about 0.2%. The only thing that looks interesting is cable has had a little run lower here briefly on the break of the low that was seen at the beginning of the week. And obviously down on S1 would be a target, given that was yesterday's low point that was seen in the morning. So it's just a matter with the Brexit stuff of continuing to monitor the situation. One thing that I would do today specifically is, I did see this last night. You might have seen me retweet this. Obviously it was the Business Insider that released the scoop yesterday with their exclusive article. So I started following them and a couple of their journalists. And I saw this chap, Adam Payne, who works for Business Insider, and he released this last night. The EU source has told him UK government is to publish its negotiating position on transition at 10 AM this morning. And then he's come good a bit later on. He's updated this morning and it's on the official parliamentary website. So David Davis is going to set out UK's transition positioning this morning. It was sent to the EU 27 permanent representatives yesterday. So as you can see here from the written statement from the Parliament website, David Davis will be speaking later on this morning on this. So for sterling traders, definitely I'd be keeping an ear out of what he has to say. He obviously gave a speech as well yesterday, which again was fairly evenly balanced from a political point of view. Nothing really shocking, but updates on implementation stances definitely needs to be monitored. But again, the other point here is about the sourcing of information. This is how your mind's got to work if you want Brexit news ahead of traditional news outlets. Following guys like him, Adam Payne, or just finding guys like him. I mean, he's got 5,000 followers, so he's not the biggest hitter out there on Twitter, but he had this information 12 hours before it actually became public. So You know, these things can be found if you do a bit of digging. All right, a few other headlines, then I'll hand you over to Sam. A couple of earnings reports, UK related. Glencore, they've announced full-year overall adjusted profit in line with expectations. They said its full-year marketing adjusted EBIT was 3 billion, above the range it flagged at the end of last year. Then having a look elsewhere, Lloyd's this morning reported an annual pre-tax profit of £5.3 billion, highest pre-tax profit since 2006, but below analysts' expectations. I believe they were still, can you believe it, but they're still paying litigation in regards to PPI and mispractice that was dating back several years. So Lloyd's making a profit, but below that of what expectations were on the street. All right, quick look at the calendar for today. Obviously, we've had these flash manufacturing service PMIs. They've really had no real market impact, I would say. If anything, they were a little soft. Equities, though, I'd say the weakness is just a little bit more of a carry-on effect of how we closed last night in the US. Certainly, the weaker data would probably help fit the narrative in that sense if we did weaken further. Looking ahead, though, there's some key things coming up this morning. 9:30, you have UK jobs data, but more specifically, and what will be more the decisive factor of how the pound moves, you have wage data. So wage data, incredibly important. You saw what happened when that non-farm payroll wage component at the beginning of the month was higher than expected. That was the trigger point and catalyst for the market sell-off then the following Monday that we had with that equity short-term correction. Not saying that we're going to get a repeat of that on the back of UK earnings, but UK earnings are very closely monitored because, if you remember last week, market pricing for a Bank of England rate hike has gone from pretty much the end of this year, or 2019, as it was originally telegraphed from the Bank of England back a few months ago, to now market pricing is for a potential May, that's May this year, interest rate hike. So a lot of this, though, is going to be contingent on these types of economic data points, particularly something like earnings, with the ongoing disparity in the cost of living, which has been diminished by the fact that the price of goods has been outweighing the amount of income that people have been getting paid. So keep an eye out for that. That definitely will be interesting. And as you always know, watch the pound ahead of the release if there's any pre-positioning ahead of it. Otherwise, going into the US session, you've got the US equivalent for the manufacturing PMIs. You've got existing home sales, which, quite frankly, I don't see any risks surrounding that figure, given the robustness generally of the housing sector there and the lack of focus from the Fed on that specific area. The main thing then that people will be looking at is the FOMC minutes. They're going to come out later on this evening, so this will be 7 p.m. Now, what are we looking at? Well, this was an article I sent out to you this morning. Fed minutes may give clues to 2018. Remember, one of the biggest things that triggered as a byproduct of that uptick in wages that we had in that non-farm report more recently was that inflation expectations were stoked, and that meant then, is this going to meaningfully change the perception about how quickly inflation is going to move higher, and as a consequence then how quickly central banks will need to tighten monetary policy. Now the key here is the Fed is saying at the moment they want to hike interest rates 3 times, but a growing chorus on Wall Street is suggesting they're going to do 4 times. So one of the main things that happened when the Fed released their initial statement in January was, for the January meeting that is, the minutes said the word further. Now that when you're trying to trade the nuances of a monetary policy statement, one word is all it takes. Now, Federal Reserve officials in that last statement added the word further twice in the January statement. The key is, what do they mean by further? So the central bank pledged twice to make further gradual adjustments in interest rates as opposed to gradual adjustments. So what we're looking out for in the minutes today specifically is, what do they mean by this? Do they mean that basically they're raising the debate about potentially more rate hikes? Were they referring to the fact that you've got the corporate tax coming in, you've got potential deregulation of, let's say, the financial sector from Trump, you've got fiscal spending to be increased by the US administration, giving them some flexibility that potentially this rate trajectory could change and become more steeper? What was the thinking here? So this is what people are going to be chewing over the minutes for, and what will consequently create the reaction when we have that at 7 p.m. The other thing, speaker-wise, you've got Fed's Harker in the afternoon, Mark Carney and a selection of the Monetary Policy Committee are appearing before the Treasury Select Committee this afternoon. I would say, although it's worth being aware that he's speaking, this isn't going to move the market. It never really does, because this is just the repetition of the existing guidance when they speak to the politicians, in short. Final thing to mention was, you might remember, if you've been following our briefings for a while, I was mentioning probably about 10 months ago about cobalt, and how there was big buyers of cobalt that had seen the price move about 80% in a very short time frame. Why has it been strengthening? Well, it's a major ingredient for batteries in regards to electric vehicles, and as we know, the automobile market is going through quite a substantial shift towards electronic products going forward. And so there's been a lot of buyers trying to corner the market. I think there's a firm in Toronto that's bought a huge degree of the physical cobalt available at the moment. But quite interestingly, this has come out, and it just kind of shows the situation with this particular commodity, because Apple are in talks to buy cobalt directly now from miners. So away from the car makers, Apple is the biggest other non-automobile related buyer of cobalt on the planet. Why? Because they need it as a key component in mobile phone batteries, in a similar sense to how they're used in electric vehicles. So to give you an idea, Apple are looking to sign contracts direct with miners for several tons per year for a 5-year period. What has this meant for price? Well, in the last 12 months, cobalt's up a cool 205%. Now, I know that's a drop in the ocean compared to crypto, but this is a real market with a tangible physical resource, and a 200% return in 12 months is a pretty tasty prospect. So I hope some of you got involved a few months ago when we were talking about cobalt at the time, because it's almost doubled and some since we were last speaking about it. All right, hand you over to Sam quickly, and then he'll have a brief overview of the charts. But have yourself a good day, and I'll see you in the chat room.
Yeah, good morning, guys. Obviously, in just under 5 minutes, you've got the data, so I'll try to wrap up a bit quicker than normal. Let's have a quick look over at the euro just before that comes out. Obviously, not expecting to see the biggest move from this particular release in terms of the morning and the data. I think 9:30, perhaps seeing a beat or miss on expectations for any potential sort of earnings out of the UK could be the main driver. But in terms of where we are in the euro, you can see a bit of a break lower, only to come back this morning. Let's just put this on a longer time frame just quickly. In terms of levels to the downside, if we do push on, I think the 123 handle on the futures and what was the low of the 14th looks a good area of support. Obviously above there you've got the S1, and then if we were to drift back higher, I think the sentiment at the market for the moment for the market is to the downside. Obviously we've been on this very long-term uptrend, but in terms of today, looking for potential places in the market where we could get a good short. Obviously the higher the day seems quite a long way away, so it might well be that any potential resistance point, where we've just found some, or just a bit above around here could be the ideal place. We have been trending down lower, so definitely worth getting a trend line or two on this market to see if they are being respected. So a quick look over at pound once that loads up. It's just working for now, but obviously you got this data coming out in just under 2 minutes. Here we go, pound is loading up. So we have broken through. Be interesting again to see, in that sort of 10-20 minute build up, to see if there has been any move in the pound currency to perhaps give a potential leak. We have broken through the sort of lows that we made yesterday afternoon before sort of retracing a bit. We've broken through the low of today as well, and that's sort of acting as a ceiling, if you like, for now. A breakthrough here, you can see why we found support using the 1030 low yesterday pretty much to the tick. A breakthrough there, S1, yesterday's low, could offer a good area of support before even coming to what probably is the key area to the downside today, that high of the 13th, pretty much the low of yesterday, 139.42 on the future. So that would be the key level that I'm looking at. I'll stop in a minute, well, in about 30 seconds, and get back on the mic, just as we have the European data coming out. So I'm just going to leave the euro up here just to see how we can, if we do react to that. So mute me if you want. In 20 seconds we've got the data, so I'm just going to leave this on and I'll get on after the release comes out in 10 seconds.
10 seconds. $58.5, so that's 58.5, below expected 59.3, services 56.7, below expected 57.6, the composite at 57.5, below expected 58.5, same fitting with the French and German readings, Eurozone here a miss across the board.
Yep, so just to reiterate what Ran said, you saw the French, saw the German readings this morning, missing expectations, and as usually is the case, that is quite a good lead indicator for the main European release to also be negative. This isn't top tier change the world kind of data, but in terms of sentiment of the market, it hasn't really changed anything. It might well be that you're looking here for this low of the data break to perhaps get a push on through. You can see here why we perhaps made the low where we did already this morning to find support. So a breakthrough here could offer a bit of downside to the S1 low of the day. US equities coming towards their lows as well. Again, similar sort of patterns that we saw on the Monday. Let me just get a quick trend line over here. You can see similar in that respect, just sort of getting squeezed in almost. But if we do get a breakthrough the overnight low and today's lows, you can see the next sort of key area is a fair distance away for the Dow. So one to keep an eye on. I think the sentiment right now should be to focus on that downside. For the Nasdaq, a bit more supported, but again, if you got that trend line on now, officially you have kind of got a break of that, albeit the pivot and a few areas of support just below. So these US equities just coming towards their lows. I'd favour the downside break for now, but not being too aggressive given the time of the day. Let me just see if we are just a couple of trend lines to have on. I think as well, you're going to see the DAX come lower. This could be the lead. If the DAX was to really kick on, it could filter through. The FTSE a bit more supported than the US, but still sort of in that trending down kind of phase. If we just put this back, this is the CFD, you can see it's been quite well respected. You've got the highs of each day just getting lower, but also the lows, just getting higher quite slightly. And so it'd be interesting to see if we can get a break of those levels and the momentum is there, then we could start to look to push down. We'll have a quick look over the commodity markets that we trade here. Oil, we had the breakthrough, that level support, but then it got quite messy before hitting up at the sort of the higher end of yesterday's day, finding a bit of resistance to then come back. Being Wednesday, this evening you got the API. Usually, obviously that's Tuesday 9:30, but Obviously the bank holiday pushes that back, so perhaps waiting for that. I think a key area today could be yesterday's low, 61.42 to the upside, and then you've got the bottom of what could be the range around 60.75 on the futures, where we did find support back here on the 16th. In terms of getting into a trade right now for oil, obviously I'd look to probably stay away, maybe wait for the volume to really pick up again. Gold, which had a pretty big move to the downside yesterday around sort of 3 o'clock, you can see here really pushing to the low, has been drifting lower since, albeit we have found a bit of support over the last hour as equities do drift lower. So one to keep an eye on as well. Let's have a quick look over the yen to finish here. Let's mark up that high of the day that we made early hours this morning. You can see really strong resistance area that we found support. When was that? On the 14th, which was previous resistance. So key area for this market, perhaps to the upside. To the downside, I mean, you can have yesterday's high in the mix there as a potential area of support. 26 minutes to the UK data. Then you've got probably a bit of a, if that sort of were to come in line, a bit of a lull into the afternoon, and then could pick up again. But for now, I'd keep my eyes on US equities for pounds if we have any sort of leak, if you like, and whether the euro can continue to push through that low of the day and open the door to S1 and beyond. Have a good day, and I'll catch you in the chat.